Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. My name is Bobby Rains. I'm here for our once every 3 weeks or so Investors Observer Members Only Workshop. So yeah, let's get started. All right, so here's our agenda today. We got a quick look at what's going on at Investors Observer. We're going to look at some charts. We'll talk about what else is happening in the market and the economy. Take a look at some things that are hot right now. And then the rest is what we call member-driven content, questions, site demonstrations, etc. I got a bunch of great questions ahead of time. Always appreciate that. I think it makes the presentation better. You certainly get a little bit clearer answer from me if I have a few minutes to think about it in terms of preparation. As always, I can prepare slides for questions ahead of time. Just mention the workshop. A lot of people just reply to that workshop invite, but yeah, you can also just submit a help desk ticket at any point and say, hey, can you talk about this in the workshop? And we're always happy to do that. All right, but yeah, will still be plenty of time for questions at the end today. So, if you have questions at any point, just throw them in that question box there, and we will get to them either as we go or at the end. All right, let's get started. All right, so what's going on in Investors Observer? I think I talked about this last time, but we're working on an Android app. We're hoping to have it done later this year. We have another big project that I'm not going to reveal details on yet that will also be done hopefully this year or in the first quarter of 2022. And we're already lining up, site improvements and things like that to work on for the rest of 2022. I think the next few months here, once we get the Android app behind us and a couple of other things, will be pretty big in terms of features and things we'll be adding to the site. I'm pretty excited about it, and my team is pretty excited about it. So there's some things to look forward to there. All right. So let's look at some charts. The S&P 500, I draw a red line periodically on this chart when it kind of seems like it hits a top that might be resistance going up or support on the way back down. But yeah, there's not really much to report here. The market's been it hasn't been bad necessarily, but it hasn't been super good necessarily the last couple of weeks either. It's just been kind of meh, which is fine, right? That happens. Sideways can also be a little bit of a correction in the sense of, right, things having a chance to catch up. And as we look at the next few slides, we'll see, right, like, sure, the overall market hasn't really done much, but there are things that are going up and things that are going down. It just turns out that on average across the 500 largest stocks, there's not a whole lot of action right now. All right, the NASDAQ definitely went up a little bit more than the S&P 500 in its last rise, but it's also been pretty flat the last, let's call it, week or so. We got kind of to the end of earnings. The Fed said some things. You get a big run up and then there's kind of a lull is to be expected as things catch up. Small caps are much more interesting. We've been in kind of this range for basically all of 2021. And we're, still there. This is a thing we'd like to see some more momentum on in terms of breaking out to the top, but also, an index of 2,000 stocks, it turns out there's a lot less correlation here than there is in, even something like the S&P 500, where there's some big names that account for a pretty big percentage of the index. There's much less of that going on in the Russell 2000. I forget exactly what the percentage the largest company in the Russell 2000 is, but it's nowhere close to, in the S&P 500, those top 5 stocks are roughly 20% of the whole index, so they can really move it. Whereas here, you just don't have that. As we'll talk about, some sector rotation and things like that in a couple of minutes. The Russell really things kind of come out in the wash here because you don't have, the big tech or some of the other things to kind of help lift the whole index, even if there's a few laggy bits. All right, so the S&P 500 versus the S&P 500 equal weights. The equal weight is in blue. And the reason I like to look at this is because of that concentration at the top of the S&P 500. Those big tech companies can really pull the market in ways that can be misleading if you're just looking at the cap weighted S&P 500, which is sort of the classic way to do it. And so if you look at the blue line here, what you notice is a couple of things. One is it seems to be a lot more volatile, right? The ups are higher, the downs are sharper. That's typically what you expect with smaller stocks. And then here more recently, we can go back a couple slides, right? The overall S&P 500, it's down not that much over the last couple of days, but the equal weight is down more. So what this suggests is that the big techs at the top of the S&P 500 have been kind of holding everything else up. So if you have an index fund, you're probably not doing so bad these last couple of days. If you're holding a set of individual stocks, well, it really depends on which individual stocks you're holding in terms of what your performance looks like. It may be pretty good. It may be less good. Even so, we're talking about, not a very big move here, but still, the relative size of these is because there are those sort of overweight names at the top of the S&P 500. All right, so growth versus value. This one gets kind of interesting after sort of leading for a long time in 2020 or 2021. Value is catching back up, or sorry, growth is catching back up. Value was the leader, but growth is catching back up and is even ahead a little bit. And again, we see the same thing here. We have a bigger downward move here recently. In the value than we have in the growth, and that's right. Growth is things like tech stocks, and value is, things that are not expected to grow as fast. Typically, right? They may be, more profitable. They pay bigger dividends. There are plenty of reasons to buy value stocks, but sort of top line growth is not necessarily one of them. So yeah, it's been interesting to sort of see this come back a little bit and close up some of this divergence. All right, so what else is going on? The Federal Reserve is still kind of the big market driver here. I mean, really it's guesses about what the Fed might do. The market didn't love that jobs number last week, but it wasn't, the reaction wasn't as bad as it could have been. That was, kind of a big miss, but what it probably means is the Fed can hold off a little bit longer in terms of scaling back bond buying, or, I guess the real end game there is raising interest rates. And so you get a weak jobs number, and it's less about, the actual number than what the Fed is going to do based on that number. And so that's how we get to here. Anybody who was in the market in 2012, 2013, when the post-financial crisis taper started to happen, it's the same basic playbook, right? Sometimes you get bad news is good news, and good news is bad news. All right, Delta is the other thing, right? People are starting to worry about coronavirus again. We had a few months over the summer where things were looking good. People were out and about and doing stuff, but people are, definitely changing behavior again. And then on the economic data side, the JOLTS report was out today. It looks back to February, so it's not as fresh as the report we got last week, but it does have a little bit more granularity. Job openings remain, I think, at record highs. The quit rate is also very high. So job openings is sort of an easy top line number to understand, right? It's how many jobs are there. The quit rate, I think, is pretty interesting, because what the quit rate tells you is how confident in the job market are the people who are participating in the market, right? You don't quit your job unless you're pretty sure you can get another job. So for the quit rate to be high means people are changing jobs, nobody voluntarily changes jobs for a step down. So they're changing jobs, hopefully to move up. They feel pretty good about changing jobs. They're not super worried about a recession. Even if you have an opportunity to make a step up, sometimes if you're really worried about the economy, you don't want to be the most recent guy hired. So maybe you stay where you are in that case. So a high quit rate is typically a sign of, it's not consumer confidence, but it's like worker confidence, let's call it. And so a high quit rate is maybe somewhat paradoxically a pretty good sign in terms of the health of the at least the labor market, but the labor market is a pretty big part of the economy since that's where people get money to spend. But yeah, the other thing that's kind of an ongoing story is supply chains are still super weird. The story in lots of industries is about difficulty in getting certain things, right? Like, I feel like we've talked about bicycles a few times because that's a personal interest of mine. There's still a shortage of bicycles and parts. Semiconductors, I think everyone's familiar with that story, right? Like, since semiconductors cascades over into all sorts of things. I think maybe most notably automobiles, but it does have some spillover in some other places. But the housing market has gotten super weird because one, housing supply is tight, but home builders are complaining that they can't get windows. There's months and months to get windows wherever those are made. There's some backup in terms of getting them produced. I saw somebody talking a couple weeks ago about how they were having a hard time getting trusses to put in new houses because I don't know if you've ever seen a roofing truss, but there's a metal plate that kind of holds the boards together where it comes together. People were having a hard time getting, the two companies I think in the whole world make those little metal plates, and those companies were having a hard time getting steel. So there's a lot of weird supply chain stuff going on that's causing some shortages and some price distortions. Obviously, a house is a big purchase, but yeah, it turns out that if you have to wait weeks or months to get things like windows or trusses, it's really hard to increase the supply of housing to meet the higher demand. So that's kind of what happens here. I think that the actual housing market may have taken a couple steps toward cooling recently on a national level. I think some places probably still higher than others, but it's really hard to get new supply of houses online. It takes a while to build a house anyway, and stuff like this only makes it take longer. All right, so the stuff that's hot right now in the market, real estate, still pretty hot. And I get this by looking at here, we'll just go look at it over here. This sector and industry page, and specifically in terms of like hot right now, what I like to look at is the short-term technical score. So this is, the things where on average, the stocks in these groups, so sectors are your bigger groups, there's 11. Industries over here on the right are your smaller groups. There's actually 146 of those, but a list of 146 things isn't that useful, so we just show the top 10. But yeah, these are the things where the stocks in those groups have been moving up, more than other things over the last couple of, say, weeks. Up to about a month is about as far back as this looks. So things that have been stronger over the last month than the other things. And so new entries to the list this time through are financial conglomerates. Uranium, there was a big merger, and it's a pretty small industry, so that one may be a little bit of an outlier. Financial services was not on this list the last time we talked. We can go back to the slide now. Yeah, but REITs are still hot, right? Residential and industrial REITs. The retail REITs have weakened a little bit from the last time we talked, but they still make the top 10 there. Some of that's about interest rates, but depending on which REITs you're talking about, right? Leases are getting negotiated at higher prices. Financial services is new to the list this time around. Financial conglomerates tops that. And financial conglomerates is companies with a broad portfolio and no main source of revenue. So like JP Morgan and Goldman Sachs are not on this list because they have particular things where they get most of their revenue. So they actually fall into sort of different buckets. But think companies sort of like that, where maybe no one piece is bigger than the other. Specialty insurance has also been pretty hot recently. A lot of that is probably things like mortgages, right? You got a lot of people buying houses. Mortgage insurance falls under the sort of specialty insurance category. There's also probably some hurricane related items, as well as, we saw a lot of new business formation come out of the pandemic. And yeah, if you have a new business, you're going to want to have some new insurance to cover that. So that's probably what's going on there. And then, yeah, regional banks starting to heat up again. Some of that's probably interest rates, but a lot of it is probably, again, right? Like you start a new business, you need a new bank account, you might need to borrow some money. There's a bunch of things you might be doing that are going to generate some fees for a bank somewhere. And especially as a small business, it's sometimes nice to sit down across the desk from a banker as opposed to have somebody you deal with over the phone, which is frequently what happens with some of the bigger banks. And then, yeah, industrials are still on the list. I think uranium is a little bit of an outlier, but industrial distribution is, still hot. Staffing services, those are both, growing economy kind of things. Industrial distribution and staffing services. Off the list is consumer cyclical, and I think that's really getting back to that Delta thing that I was talking about earlier. I think, yeah, people were out and about and doing stuff, and now things look a little iffier. So, they're still changing jobs, which is a good sign, but that front line in terms of being free with the spending is maybe a little bit less right now. All right, so let's get to the question. All right, hang on, we have a thing here. All right, regarding uranium, is China now building new nuclear reactors for electricity generation? Let's see, that's from Eric. Eric, I think China is building some new reactors. It is not allowed to export uranium from the United States, so I don't think North American uranium miners are really servicing that need in particular. But that could be some of the heat behind uranium, but also a big piece of it is probably this chart here. CCJ is one of the biggest uranium companies, and they are, I think, maybe getting bought. I don't remember exactly what the deal was. But yeah, their stock has just been on fire recently. Nope. All right. But yeah, that's the kind of thing, especially in a relatively small industry like uranium. There aren't, it's not like banks where there's a whole bunch of them. There's only a few. There's only a few players in the uranium space, and so that can sort of be an outlier. All right, so now back to the question. So Marcine asked, what is the best place to check for most recent insider trading data? So let's talk about that first. All right, so the best place to check in terms of the most recent insider trading data is to go to Edgar, which is the SEC's repository for documents, and you can search. I don't usually search this way. Here we go, daily filings. Here it is, latest filings. That's what I was looking for. All right, so if you go to latest filings, you can say only this ownership thing, retrieve filings, and this will give you everything that's been filed. Here's the top 40, and that takes us back to 4:15, which is about 5 minutes ago. This is, it turns out, not the best way to actually look at this. It's the fastest way to get the information, absolutely. There's a particular company you're looking for. Obviously, you can search for the company, and that helps narrow it down. But kind of one of the things about ownership data is that it is There is both a lot of it, and it is not necessarily presented in a great way. You know, typically most of the good stuff is in a footnote. The form is actually pretty boring, but a lot of them can be pretty meaningless, right? There's people who are selling stock to pay taxes, option exercises, which typically means the options are in the money and we're about to expire. Those things are just sort of normal course of business, right? So honestly, our news partner, MT Newswire, keeps up with these pretty well. They sort of filter out a lot of the like tax sales and option exercises and some of the things that aren't super meaningful in terms of finding what I would call like sort of the real buying and selling. And they also keep track of company-wide trends. So, you know, some guy sells a few shares, that might be nothing. But if some guy sells a few shares and it contributes to a company-wide trend of more selling than buying, now that might be something. And so you can find that stuff. It's, you know, obviously in the news feed on the company page, but you can also find it under this insider activity here. And so you can see, you know, a lot of what they do is actually the trend following, but pretty much every one of those documents we were just looking at over here, if it falls into the category of what I would call sort of real or important buying or selling, it's going to show up over here. You know, there's a little bit of a lag because obviously they have to kind of parse the data, but you know, it beats trying to sort through all of this. All right. So yeah, I mean, top 3 data indicators for growth over 25% is sort of, yeah, I don't know. Anybody's guess? I mean, you're probably going to just exclude some industries there altogether, right? Like your utilities and some things like that probably just aren't going to ever grow more than 25%. That would be pretty bananas. So, you know, look at things like technology, communication services, maybe a few places in the industrial sector, but probably not that many just because achieving scale on that level is hard. And then, yeah, things like consumer cyclical, it's also possible. But yeah, like that's, I mean, if it were as easy as being like, oh, well, here's the 3 keys to find things that will grow more than 25%, everybody would do that. And then the, you know, that's just not how it works. All right, so JS said, I was wondering, since even the most pessimistic analysts anticipate growth for Zynga, can it be considered a no-brainer to buy, or is an update to come since the last results? All right, so the big caveat for any sort of analyst rating is you're only looking at the analysts who cover Zynga, right? So even the most pessimistic analysts who cover Zynga anticipate growth. The way all of that sort of Wall Street analysis game works is essentially they're trying to attract, you know, they're selling their research to, you know, a lot of retail customers. Some of them are very high-end retail customers, some low-end money managers who are then, you know, turning around and using that to put things in, you know, put their retail customers in. And there's, you know, a few sort of, you know, people who are running funds or whatever who might look at it as well. But in any case, all of those investors tend to be mostly long, right? They're mostly buying stocks and not shorting stocks. And so what that means is the incentive here is to publish buy ideas, right? Like me doing hours and hours of research to say, hey, you shouldn't own this stock, especially something that's relatively small like Zynga. Well, that might be useful for, you know, the handful of people on my client list who own the stock, but most of the people on my client list aren't going to run out and short it just because I say the stock is no good. And so what happens is stocks that seem overvalued or otherwise unattractive may get a sell rating for a while, but eventually, you know, it takes a lot of time to maintain those ratings. You got to listen to the earnings calls. There's a lot of modeling, various other things that goes on. It's really just a better use of your time in terms of, you know, the incentive structure there to get rid of stocks that are sells, just drop them from your coverage universe and go find a stock that you think should be a buy. And so that's why if you look at our website, the analyst ratings, you can see something that has a buy and it's, not in the top half of stocks that have a rating. And that's because, most stocks have a buy or a strong buy rating. Like a hold is relatively rare. And then sell and strong sell, people will slap those ratings on, and occasionally you'll get something like that, something that stays out there for a long time, but it's not, it's just not common to maintain a sell rating on a stock for very long. And so those things end up being, sort of skewed toward the bullish side. So you get only the analysts who like the stock are covering it. And especially for smaller stocks, right? Like if you really think Apple is a sell and you work for one of these, big investment banks, you can keep your sell rating on Apple. That you're not wasting your time and going to drop it to go find some other stock that people are going to be more interested in. But for Zynga, nobody's going to spend a lot of time trying to maintain a sell rating on Zynga. That said, though, the analyst ratings can be an important part of any analysis because there is, they are people who spend a lot of time looking at that, right? Like no analyst coverage is a sign that there's something going on there, right? Like analysts cover some pretty small stocks. So if your, stock has no analyst coverage and it's, even, above a, penny stock, there's probably a reason no analysts are covering it, and it's probably not because, they just love it and are keeping it to themselves. But yeah, you should really understand when you're looking at that you're only getting the opinion of the analysts who like the stock, right? The analysts who don't like the stock go cover something else. And the other thing is you should consider your strategy, right? So a 12-month price target is great, but it doesn't really line up with anybody's sort of investment horizon, right? Like there are no people whose target holding time is exactly 12 months. If you're a swing trader or something like that, 12 months is forever. Like who cares? But if you're looking to hold things for decades, then 12 months isn't really that relevant either, right? I mean, if you're sort of from the Warren Buffett school, then 12 months isn't really a good time period. So, I do think they're worthwhile. Obviously, we have them on our website. I do think they're worthwhile, but I think they should be considered kind of in the broader context of who's making these recommendations, why are they making them. I don't think anybody's necessarily being dishonest, but there's just a lack of incentive for, analysts to publish negative opinions about stocks, and so you don't get a lot of it. But yeah, look at the valuation and earnings history to see if what you see there lines up with those price targets. And where anything forward-looking is a guess. So really, if you can do even some cursory analysis and the analyst estimates seem reasonable, then yeah, by all means, like that can be a great stock to buy. But don't lean too heavily on essentially a self-selecting group of people who like the stock, right? That just doesn't. I mean, if you go to the Tesla fan groups, they will tell you that Teslas are the best cars to buy. But it turns out there aren't a lot of Toyota owners there just because it's a Tesla fan group, right? The group ends up being somewhat self-selecting. And so, yeah, that's kind of how I feel about the analyst estimates. All right, so Marty had a question about Intuitive Surgical, ISRG. It's going to split 2 shares for, it's a 2-for-1 split on the 27th. The stock is trading at 1078. So he says splits don't change the value of the stock, but in general, do I favor splits? So splits are, like he said, largely irrelevant to the price of or to the value of a stock, right? It's the same pie, we're just slicing it differently. I can cut a pizza into 2 slices. I can cut a pizza into 10 slices. It's the same, it's the same size pizza, right? Like there's no magic there. A stock split doesn't make the stock worth more. It doesn't make it worth less. On the very low price end, right? Like it's essentially a tool that companies use to control the price of the stock. And on the low end, you actually see reverse splits where they essentially combine shares to raise stock prices. that can tend to lower the share count, but it raises the price, which, the major exchanges, NASDAQ and NYSE, et cetera, have, some minimum listing requirement. They don't want stocks to trade at 50 cents on their stock exchange. So if your stock price falls super far, one of the things you can do to get the price back up is just, basically combine some shares and raise the price. GE did this kind of recently. I don't think they were in danger of being delisted, but they did do a reverse share split. Citi did a 10-for-1 after the financial crisis. And yeah, their stock went from $4 a share to $40 a share, but so what, right? It was still the same bank. There is, I think, some perceived boost in terms of quality, right? I don't think anybody thinks that a stock that trades for $3 or $5 or $7 is, a blue chip stock, because the price will be higher. So that's the reason you see companies like GE that aren't really in danger of being delisted, but would just like to have a higher price do a reverse split. Yeah, and on the high side, a lower price can actually increase liquidity, right? So at $1,000 a share, you lose a lot of the small retail investors that have been kind of a big story in markets over the past year. You might can buy one share of that, if you're a small investor, but you might not want to put 10% of your portfolio into one stock. So you might just stay away from it for that reason. Some of the brokerages have fractional shares now, which I think got rid of some of this, but not all of it. And then, I don't know that ISRG is going to be included in the Dow. I would kind of doubt it, but there are some indices and index providers that have sort of price requirements. The Dow is one of those because it is a price-weighted index. Apple essentially did a split several years ago so that it could be included in the Dow. So, those are kind of the reasons to do it. But for investors, lower stock prices can kind of be preferable, right? You can better sort of calibrate your position sizes. Like I said, if you have a $10,000 portfolio, you probably don't want to put 10% of it into ISRG, right? That would be kind of silly. So splitting the stock, well, that means that now you can buy, you can put 5% of your portfolio into it at one share. That gets to be a little bit more attractive. It also can make options a little bit more useful. Small dollar or small percent movements in something like an Amazon in particular can cross a lot of strike prices, and so it can be a little bit disorienting to try to think about look at an Apple trade or an Amazon trade versus a trade on, say, I guess Costco's a couple $100 now too. But say, Costco or Amazon versus Walmart, right? They're both relatively in the same industry, but 2 strikes out on Walmart versus 2 strikes out on Amazon, you're talking about very different movements in the stock to totally wreck that position. So I think for options traders in particular, lower stock prices can tend to be a little bit more useful. Also, when you get to Amazon, you get a lot of times there's $10 strikes, which means that you're just, for credit spreads in particular, you're putting a lot more at risk there. Whereas, for a stock that's in the $50 to $100 range, you get dollar strikes or $2.50 strikes a lot of times. You're just able to kind of fine tune those positions a lot more. All right, so we got 3 questions from Jim. The first was, I've been playing with the stock screener, looking for good swing trades. We have guidelines for short, medium, long-term investors, as well as the top 5 picks, how to put together to find the best 2 to 3 stocks to consider for swing trades each day. What process do you go through to find the best swing trade candidates each day? To be totally frank, I don't have any such list. I've done some swing trading. We had a swing trading product at InvestorsObserver for a while. And that sort of, days to weeks time frame requires, it just requires a lot of time. I have a full-time job. I don't have time to compile a list of the 3 best stocks for swing trading every day. However, I do think that some combination of stocks with high short-term technical scores, not necessarily the 99s, but high short-term technical scores, and then keep an eye on the sentiment score for things that are hot, should probably work for that kind of a strategy. Like I don't see any reason why that wouldn't. Just knowing what goes into those scores and how they work, and having seen kind of how they work together over time, I think that would work. But yeah, I don't keep a list of the 3 best stocks for swing trading every day, just because I have a bunch of things to do that aren't swing trading, and it just eats up a ton of time because you got to watch it very closely. Is it possible to create a watch list where I can track a number of stocks without having to manually enter them? Yeah, I mean, the watch list will save from day to day. You can track any number of stocks. The list of potential candidates probably shouldn't change that much from day to day. What you probably do is you add a few or take a few off of a longer list on a regular basis. But I wouldn't think you would be starting with a fresh list at 0 every day, right? Like if something looked like an attractive swing trade and you didn't get into it yesterday, might still be a relatively attractive swing trade today. So yeah, you probably keep a list of, I don't know, whatever your number is, 5 or 10, and then maybe you add 1 or 2 every day and you drop 1 or 2 off every day. And then try to focus on the ones that look the best today. All right, approximately what time each day can we expect updated scores to appear in the stock screener and option trades? So this is almost always before 6 p.m. Occasionally something breaks and it's a little bit after 6 p.m., but almost always before 6 p.m. But it varies from day to day. The stock scores are available first, and then the option trades. I mean, the reason it varies is essentially there's different amounts of data from day to day. Right? If stocks have gone up a lot over the past month, the options markets add more. They add more strikes. So there's more options. So that means that every night we download more data, and then it has to get, more data has to get crunched. So it just takes longer. But it is always available before 6 Eastern. All right, so this was from, I think this is Deanna. I'm new to trading and looking for tools to help me with evaluating stock purchases to give me additional confidence before making a stock purchase. Is there a way to determine if a stock is overbought, oversold, or a good price to pay for it? All right, so overbought and oversold are typically used sort of in a technical context. Right, so you're sort of either analyzing the chart directly or using a tool to analyze the price and volume recently. So a stock where essentially, you can do a lot of complicated math, but essentially overbought means the price sort of went up too far too fast, whereas down too far too fast is oversold. That's usually what people mean when they talk about things like that. Now, a good price tends to get, to me, seems a little closer to what I would think of as fundamental analysis, which is, you're trying to look for value. So that involves an analysis of what the company does and how profitably they do it. And so those are going to be, on our website, sort of your fundamental score, your valuation score, the analysts' opinions to some degree, things like that. So we do actually have some proxies for, or some measures for overbought and oversold built into the short-term and long-term technical scores. So we, if a stock goes up super fast, we actually try to sort of, within the algorithm, pull it back a little bit in terms of not giving it as high a score as something that goes up sort of more steadily, because we know there is that likelihood that if the stock goes up too far too fast, it will come back down, and so we try to sort of try to adjust for that as much as possible. All right, so Rocco wanted to know, is it possible to get a quick tutorial on how to use the options scanner, explaining the filters and fields? Sure. All right, so the basics of, I'll start over here. Let's start with covered calls. The basics of the option screener are pretty much the same for all the strategies. There's a few differences, but They're pretty self-explanatory. So you can set a minimum number of days for a trade or a maximum number of days. You don't have to set either, or you can set only one. So if you want trades that expire before the end of September, right, hit that September 30, and you'll get trades that expire before the end of September. The profit thing has basically different ways to describe your profit, right? So annualized return rate, you can set a minimum or a maximum. There's no need to set either one. Definitely no need to set both, but set them as you want. Assigned return rate is, exactly what it says on the 10, right? So that is the profit divided by the amount you have at risk. The annualized return rate annualizes it, and I think that that is useful because if you have a 2-week trade or a 1-week trade, that's a very big difference in time. And so is it better to get 7% in 1 week or, 7% in 1 week and 14% in 2 weeks would be the same annualized return. So looking at annualized return, you don't have to do that other math in your head. Dividend yield is more useful for covered calls, but may provide some stability to some other, some other strategies, or you may want to look for small dividend yields if you're doing, say, bullish diagonal spreads, just because there is some early assignment risk anytime you have an in-the-money call. All right, so risk management. Net debit is going to be the amount you have at risk. So, or at least on the cover call side, in the diagonal spread, it's going to be the amount you have at risk, right? That's how much you have to pay to buy the stock minus what you get for selling the call. Overall score is just the Investors Observer stock overall score. Keys are a proprietary, this is always hard to say, proprietary risk rating. And so 5 keys is going to be less risk. 1 key will be the most risk. They are comparable within a strategy, or within sort of what I would call like a strategy family. So a 5 on a covered call and a 5 on a sold put will be about the same risk, but that will not compare to a 5 on a vertical spread. So the vertical spreads will be about the same risk in terms of bullish and bearish. The diagonal spreads will be about the same risk in terms of bullish and bearish across the numbers. But yeah, a 5-key covered call is just going to be a lot safer than a 5-key vertical spread, because covered calls tend to be safer than vertical spreads. Percent in the money is how far the call is in the money. Downside protection is the difference between the current stock price and whatever the break-even price is for the trade. Expiration date before earnings means the trade will expire before the company's next earnings date. After earnings means the option will expire after the company's next earnings date. Before or after is basically the same as leaving it blank. Sector and industry, you can, you want only basic materials, hit this. If you want to drill down even further, you can, if you only want the specialty chemical stocks, you can do that. All right, so all these are basically the same. The credit spreads get a little bit different because, right, there's this net credit, which is also the target profit, and the amount at risk is different. But so you have amount at risk here instead of net debit, but basically everything else is the same. So yeah, that is the option screener. All right, let's see what other kind of questions we got here. All right, so Eric said, what key indicators do analysts use to determine strong buys, holds, or sells for stocks? So these analyst ratings on our website, let's just pull this up because I know it has it. So Apple gets a strong buy, and then there's these price targets here. These are not Investors Observer's ratings or forecast. These are essentially aggregated from Wall Street analysts, and we just get a bunch of them and kind of give you the average rating here, and then give you the high, mean, and the low over here. And so what they use varies depending on the analyst. It is mostly a fundamental analysis sort of thing, right? They're looking at growth rates and profitability and all that kind of thing. And it can get very, very in the weeds by industry. You know, the analysts that cover airlines, for example, have a metric they like to use that is Ebitda, which is like your standard EBITDA, which is earnings before taxes, interest, depreciation, and amortization. But they add an R at the end of it for aircraft rent, because airlines rent airplanes. You know, so there's some very specialized indicators depending on the industry they use, but it's primarily a sort of it's a very fundamental heavy game. They'll look at, you know, a little bit of technical stuff, but not usually. Usually it's basically we come up with some earnings projections, and then we look at kind of what the multiples that the stock has traded at historically and try to come up with a forecast for the stock based on that. All right, so Jim has a couple more questions. Yeah, there is not a way to get the stock to default to daily instead of, or the chart to default to daily instead of 2 hours. We don't, yeah, the chart is kind of a plug-in to the website. We looked at building our own chart, and it is, yeah, it is unseemly, especially for something we have on the website for free. So we don't have a lot of features in that right now. You know, Plaid is as safe as, you know, which is what provides the portfolio link service. Plaid is as safe as using a password manager or, you know, any other, you know, service where they are storing some of your information. You know, they say they use bank level security. Plaid is actually used by a lot of banks, which leads me to believe the banks feel pretty good about sharing information with Plaid. If you get a credit check or various other things, a lot of times Plaid shows up there. You know, so it's pretty safe. I don't think there's anything on the internet that is 100% safe. But I think Plaid is right up there with, you know, logging into your bank or some of those things like that. All right. Dan, I just explained the risk ratings, but if you have more questions after that, I'm happy to tackle whatever you got. And yeah, that is all the questions so far. So if anybody else has a question they're sitting on, go ahead and put it in the box. Dan, I'm not sure what you mean when you say, can we filter for blue chip stocks? Blue chip is yeah, it's a sort of, I know it when I see it kind of thing. I think a lot of people know what it means, but I don't know exactly how I would even build a filter for that. I mean, you can sort by market cap. That'll give you, you know, pretty much the big stocks, and then go from there. But yeah, I'm not sure exactly how else to go from there. Mohammed, I'm not sure I understand what you mean by, can you explain your options buying schedule? The portfolio trades are put out pretty much on a market conditions, you know, kind of thing. When we find a trade we like, we will publish it. Now they do come out typically after the close, and that's so you can put on a limit order, you know, for execution the following day. That's easier than trying to put something out in the middle of the day and then, people get it or people get it at a different price, whatever. We've had pretty good luck, doing it this way for years. Every once in a while we miss one. Every once in a while a stock goes down overnight and we send out a cancel order and you can just go cancel it. But that's pretty much what we do, and it works out pretty well. Yeah, so we don't currently have any we don't currently have any long only option strategies. So yeah, we're just not doing that, like buying an option at a price sort of strategy. Deanna, is there any way alerts can be set up or notifications? So yeah, if you put a stock on your watch list or if it's in your portfolio, you can get notifications for certain news events. We don't have price updates, price alerts yet, but we do have, earnings, analyst upgrades, and downgrades, certain performance, certain other categories we will send you a news alert, but that is only through the app as of now. So Stan said, what is your view of Apple's option prices around their product announcement events? Yeah, this is a thing people, I don't know, maybe I've just missed it. But people used to talk about it a lot, and I feel like they talk about it a little bit less. Now there was a period for a while where it seemed like every time Apple announced something, the stock would go up ahead of it and then go down after it. It turns out the way markets work is that anytime people recognize a pattern, they tend to try to exploit that pattern, and then it goes away. But yeah, I mean, without looking, my guess is there's some additional implied volatility around Apple's product announcements. So, means the options are going to cost a little more because of that. If you like Apple and you want to sell, say, an out of the money call against some shares you hold, trying to put it across one of those events might not be a bad idea. I typically try not to trade on unknowns, right? So most of the time we avoid things like earnings or product announcements if we can help it, because I don't know what the reaction is. I would much rather try to trade based on, things that I feel are a little bit more predictable, like, examining the chart, understanding the company, having some idea of what the sentiment is and the broader economic situation as to, putting some directional bet on Apple ahead of a product launch and saying, essentially betting that stock investors will like whatever the product launch is. I don't feel like I have any real edge or insight into how that would work. All right, so Robert says, the market is tanking. Do you choose to buy a put on a particular set of stocks or an index? I mean, in terms of portfolio protection, I generally think that buying puts on an index is better than buying puts on a particular set of stocks. Right, an index will tend to have lower implied volatility than any one individual stock. You just make fewer transactions, right? Most people don't buy an insurance policy, a separate insurance policy on every car they own. They, have one sort of policy that they put several cars on. I mean, I guess you could bid that out and try to get prices on each car you own and how many miles it goes your whatever else, but it's just easier to do it on one. So that's what people do. And that's generally how I feel about put buying. The thing about that is, it's also really hard to buy insurance when the house is already on fire. And so, it certainly can be done to make profitable trades. profitable option trades, in particular when the market is crashing. But a lot of times, I think what people will do is, just have a relatively cheap and long-term put, kind of in their back pocket, like an insurance policy, that they can roll periodically, as the time value starts to leak out, as opposed to being like, oh, today's the day the market's going to crash, I should buy a put. That you tend to end up paying a lot for. Jeff, yeah, we're watching the VFC portfolio trade. We'll probably sell another call on it here soon. I'm just waiting for some strength to sell into. Well, yeah. So Robert, I mean, I guess it depends. Yeah, sorry. I'll follow up to the put buying question. Yeah, I mean, if you're gonna, if you're buying a put, you're betting that something will go down. Fine. If you are, buying it for insurance, presumably you have some portfolios of stocks you're trying to insure. And so if it's, to sort of steal from a question earlier, if it's blue chip stocks, right? If it seems like the things that are in the Dow, or correlates to the things that are in the Dow, maybe you buy puts on the Dow. If you have sort of a broad-based portfolio across a lot of sectors, then maybe go S&P 500. If you got a bunch of tech stocks, then maybe do the NASDAQ. Really, it just depends on that. Now, if you just want to bet that the market is going to go down, then probably the S&P 500, just because they're cheaper. They're, some of the most liquid options in the world. So that's probably what I would do if you just want to, sort of make a broad generic bet on the market. But if you're trying to do it for insurance for a particular thing, you want to kind of make sure that the thing you're insuring is going to have some correlation with the insurance you're buying. All right, so I have a question about a Citrix covered call. Oh, sorry, it's not Citrix, it's CRTX. Okay. Okay, so it looks like the price of the call is $51, which 51 out of 89 gets you to 37. Bear with me just a second, I can check that price. December. CRTX. All right, December. Yeah, I mean, at the money right now is at 85 in December, and it has a bid of 51.60. So, yeah, it turns out the implied volatility on that's real high. Is what is happening there, and that is probably because it's a biotech stock that went up by a lot and then back down. Yeah, it's just a very volatile stock. There may also be something in terms of a pending FDA announcement or something between now and that expiration that juices a little bit more, but that's why. All right, so Robert says, should get into the VIX and playing the guessing game. Yeah, so Dan, the reason is it's got the break even is $37 and the stock is at 90, so the stock can lose roughly 60% of its value, and you know, before you lose money. That's why it has 5 keys, is because it's there's a lot of downside protection on that trade. That's what that's about. You know, I mean, it's I mean, I don't know the stock or what exactly is going on with it, but that's pretty much what's happening there. It's you're selling a call that's worth more than half the value of the stock. That's not something you're going to see very often. But yeah, to go back to Robert's question, I've never traded VIX options. I've tried to construct strategies around trading VIX options in my head and kind of look at them, but I can see where it could work. That's another thing you could do, is buy an out of the money call on the VIX when the VIX gets pretty low, and that also serves as some manner of crash protection. But it's not something I personally have done or could tell you what a good way to operate on that regard is. All right, so it is 5 o'clock. I think you guys are probably all tired of listening to me. So I'm going to go ahead and wrap up. We will be posting a recording of this tomorrow, and we'll send you an email when that goes up as well. Thank you all for coming. Thank you for subscribing to Investors Observer. If you have questions between now and the next workshop, you can always hit this help button and submit a ticket. We get back to most of those same day. So that's probably the easiest way to get in touch with us if you have questions. But yeah, thank you for coming. Thank you for subscribing to Investors Observer.